Good news first. Deficit rainfall is down to 12% last month. If monsoon is as bountiful in September, RBI may come under renewed pressure to ease rates. But Dr. Subbarao's remarks in New York on his way to Jackson Hole to attend the annual conference of central bankers did not show any change of heart. On the other hand, he went out of his way to advocate a stable policy regime as a necessary condition to reverse the investment cycle. We will have to wait and see whether changes initiated by Mr. Chidambaram will inspire RBI to loosen the monetary stance in their next meeting scheduled for 17 September. In stark contrast, despite US economy faring better than expected, Mr. Bernanke indicated that another round of stimulus is entirely possible since unemployment at 8.2% remained unacceptably high. Going forward, market speculation therefore will center around the timing and size of bond buying program instead of whether or not. This is clearly bullish and should underpin the equity markets in the immediate future. Ironically, this hasn't pleased Mr. Romney, who has gone public about not favoring an extension for Mr. Bernanke, a Bush appointee, when he comes up for reappointment in 2013. And now for the bad news. Economic data last week was depressing. Alarmingly, in the first 4 months of the year, fiscal deficit has crossed 51% of the budgetary estimate. In the previous year, that is 2011-12, in the same period, the deficit had reached 55% of the 4.7% annual target, eventually ending up with a fiscal deficit of 5.9% of GDP. Extending the same logic, it is more than likely that the government is set to breach the deficit target of 5.1% of GDP for the current year. CRISIL, the rating agency, has projected the deficit at 6.2% of the GDP. GDP growth at 5.5% for quarter one came in marginally higher than consensus estimate of 5.2%. However, on a year-on-year basis, gross fixed capital formation fell to 0.7% from 14.7%, and private spending declined to 3.9% from 4.9%. This is disturbing. Apart from fueling inflation, which may not inspire RBI to effect further rate cuts, there is growing threat of India's sovereign rating being reviewed for a possible downgrade with consequential blow to FII inflow. Mr. Chidambaram, alive to the possibility, has promised to set out a fiscal consolidation plan and has tasked a team of experts led by Vijay Kelkar to suggest a roadmap. In a visible change of guard, Finance Ministry seems to be on an overdrive to arrest the slide. Already, transfer pricing rules have been published for advance ruling. Shom Committee's recommendation on deferment of GAR has been put in public domain for discussion. Percentage Play believes that improving the investment climate by moving towards a non-discretionary and stable policy regime will do more for attracting investment than endlessly debating high-profile issues like FDI in retail or pension and insurance reforms that remain stuck in political saber rattling. As expected, equities remained weak all of last week, Nifty ending down 2.5% at 5,258. That despite the negative news flow, Nifty showed no sign of panic, suggests that equities may be near the bottom. Based on FY13 earnings forecast, Nifty is currently valued at a price-earning multiple of 13.2 against a long-term average of over 15.1. Valuation-wise, therefore, Nifty appears to have more of an upside than downside from these levels over the next 6 to 12 months. In the short term, equities should trade in a narrow range. While there may be some upside in the beginning of the week, the corrective phase may run all of next week while the Parliament is technically in session. Having fallen below the 50-day exponential moving average last week, it is possible that Nifty may breach last week's low of 5,238 and go on to test the 200-day exponential moving average at around 5,200. Charts and technical indicators offer little clue to a convincing turnaround. But stimulus hopes in US, an expectation of decisive action post the monsoon session could trigger a rally soon. We will let you know in time whether we see attractive trades in the market. For the present, we remain non-committal except in exceptionally promising and safe opportunities. It was a resounding week for percentage. Despite a weak market, our quant pair fund maintained its consistent performance and continued to return an annualized 16.7% and an outperformance over 24% against Nifty on an annualized basis. Likewise, our success measure of number of wins to number of losses remained at a flattering 80% in a market which most players unhesitatingly describe as treacherous. We did tweak our algorithm to suit the current conditions of an uncertain trading market. This has led to quicker turnover at lower risk, but at the same time has brought down the average profit per transaction. Competitive Value Fund, which has now been running for 15 months, widened its outperformance to near 11% against Nifty. This despite carrying substantial mark-to-market loss on Bharti Airtel. We believe it is largely the result of our stringent selection of the stock universe comprising of only the large cap good governance leading counters. For the next week, we have several stocks on our watch list: GlaxoSmithKline Pharma, Siemens, Colgate, and Tata Global Beverage, to name a few. Thanks for watching.